California does not reward the uninformed. It taxes them.
Yep, it sure does. And it's not going to be good if Proposition 13 gets shelved.
Passes.
No, passes 13, yeah.
If it passes, then it's not good news for anybody that owns property in California. It's especially people who bought a long time ago. It's going to ruin their whole thing. California has the highest state income tax in the nation, one of the most complex property tax systems in the world, and a capital gain structure that can take nearly a third of what you built.
Yeah.
And most high net worth women navigating divorce, probate, or a major real estate transaction find out what that means after the transaction closes. This episode is the conversation that should happen before anything is signed. Why California is a tax battlefield?
Because everything's so darn high.
And it's a complicated state.
It is.
The state has a lot of complicated taxes. And if you don't understand that and you don't have a plan...
Yeah, it's going to bite you.
Big time. California is the most beautiful state in the country and the most expensive place to make a financial mistake. We have the highest state income tax in the nation, 13.3% at the top bracket. We have property tax rules that were written in 1978 and have been amended so many times that most people, including many accountants, don't fully understand them. And we have a capital gains structure that, combined with federal taxes, can take between 30 and 37 cents of every dollar you made on a property sale. Most women find this out after they've already made the decision, after the divorce settlement is signed, after the probate sale closes, after the property transfers. This episode exists so that you find out before.
In 45 years of California real estate, I have watched more wealth destroyed by tax ignorance than by bad markets. A bad market takes value temporarily. A bad tax decision takes it permanently. The women who came out of major California real estate transactions with their wealth intact are not the ones who
had the best attorneys or the best agents. They're the ones who had the tax conversation first, before any document was signed, before any property changed hands, before any settlement was agreed to.
Absolutely,
Welcome back. I am Natalie Francine.
And I'm Alexis Nassif. This is Wealth, War, and Real Estate, Season 2, The Inner Circle.
For women,
by women, and men too. Feel like my sunglasses?
Yeah, but don't you think you should do the show without them?
Oh, probably. I just wanted everybody to take a look at how fantastic they are.
Oh, they are fantastic,
I love
Alexis.
them.
Just a little bit of bling.
Yeah, just a tiny
I mean, you
bit.
can always put them in at the end, but maybe you should let everybody see your beautiful eyes.
Well, thank you very much. Yeah. I will.
Absolutely.
The Proposition 13 Foundation. Let's start with Prop 13 because everything else in California property tax builds from it. In 1978, California voters passed Proposition 13. It capped property taxes at 1% of the assessed value at purchase and limited annual increases that assessed value no more than 2% per year, regardless of what the market does. What that means in practice, a woman who bought a home in Brentwood in 1985 for $400,000 is paying property taxes on an assessed value that has increased by no more than 2% per year for 40 years. Her neighbor who bought the identical home last year for $3.2 million is paying property taxes on $3.2 million. Same house, dramatically different tax bills. That is Proposition 13.
And here's where it gets complicated and where women in a divorce, in probate proceedings, get caught. That low assessed value is attached to the original owner. When a property transfers through a sale, through a divorce settlement, through a probate distribution, it can trigger a reassessment to current market value, which can mean a property tax bill that is 3, 4, 5 times what the previous owner was paying. You inherit a property from your mother worth $2.8 million. She was paying $3,000 a year in property taxes on her 1970s assessed value. After the transfer, depending on how it's structured, you could be paying $28,000 a year. That is not theoretical. That happens every day in California.
The critical word in everything Natalie just said is depending on how it is structured, because there are exclusions, there are planning strategies, there are ways to transfer property practically between parents and children and between spouses that can preserve the Proposition 13 base year value. But they require planning. They require execution before the transfer happens. And they require an understanding of the rules that most people simply don't have. They don't have the understanding because they don't know what it is.
The war. Proposition 13 is one of the most misunderstood elements of California real estate and one of the most consequential. The difference between a well-structured transfer and a poorly structured one can be tens of thousands of dollars per year in property taxes permanently. In a divorce or a probate situation, this is not a detail. It's a foundational financial decision that must be made before any transfer occurs.
The parent-child exclusions and Proposition 19. Big deal.
Now, we have to talk about Proposition 19 because it changed the rules significantly, and many people are still operating under the old assumptions.
Proposition 19 passed November 2020 and took effect February 2021. It significantly narrowed the parent-child exclusion that previously allowed parents to transfer any property to children without triggering reassessment. Under the old rules, Proposition 58, a parent could transfer their primary residence and up to $1 million in other real property to a child without reassessment. Many families use this to pass investment properties, vacation homes, and rental properties to the next generation while preserving the low tax base. Under Prop 19, the primary residence exclusion still exists, but the conditions: the child must use it as their primary residence within the first year, and the exclusion is capped. If the property's market value exceeds the assessed value by more than $1 million, the excess is added to the base. The investment property exclusion is essentially gone. Go to your accountant and find this out.
Which means families who assumed they could pass their California investment portfolio to their children with the Proposition 13 tax base intact are discovering that assumption is now wrong. The judicial war here is very real. I have seen estates where the distribution of real property had to be completely restructured because the original plan was built on Proposition 58 assumptions that no longer apply.
Capital gains, the tax nobody plans for.
Oh, and they are usually not discussed by their attorneys or their accountants until somebody asks about it.
Until the transaction is just about done, yeah, and then it's too late. So
it is a conversation that needs to be had.
Yeah, way before anything.
Absolutely.
The reality
And I'm
of
glad
capital
we're
gains.
talking
Yeah,
about
it's
it.
good. Capital gains tax is the tax nobody plans for until it's too late to plan. When you sell a property in California for more than you paid for it, the profit is subject to capital gains tax. At that federal level, long-term capital gains rates are 0, 15%, or 20%, depending on the income. California taxes capital gains as ordinary income, which means at the top bracket you are paying 13.3
percent on top of the federal tax. For high net worth women in California, the combined federal and capital state gains rate on a major property sale can approach 37%.
That's a lot.
Let me make that concrete. A woman buys a home in 1995 for $450,000. She sells it today for $2.8 million. Her gain is $2.35 million. She gets a $250,000 primary residency exclusion, so her taxable gain is $2.1 million. At a combined 37% rate, she owns approximately $777,000 in capital gains. She's just sold for $2.8 million and wrote a check to the government for $777,000.
And in a divorce settlement, this is where the judicial war gets expensive. If the settlement requires a sale of the marital home, both parties share the capital gains liability. If one party is buying out the other, the tax basis follows the property. If the settlement is structured incorrectly, one party can end up holding a property with massive embedded tax liability they didn't account for in the settlement negotiations. I have seen women agree to keep the house in a divorce settlement because they wanted the house without understanding that they were also agreeing to keep a $600,000 capital gains liability that would hit the moment they eventually sold.
That is the conversation that needs to happen before anyone agrees to anything.
The most powerful tax deferral tool available to California real estate owners is the 1031 exchange, and most women navigating high stakes real estate situations have never used one. A 1031 exchange allows you to sell an investment property and defer the capital gains tax indefinitely by reinvesting the proceeds into another investment property of equal or greater value within a specific time limit, 45 days to identify the replacement property, 180 days to close. The deadlines are absolute, has to be done.
The critical distinction, and this traps people up constantly, is that 1031 exchanges apply to investment property, not your primary residence, not a vacation home you use personally, investment property only.
But in an estate situation, in a probate sale, in an inheritance investment properties, absolutely qualified. And using a 1031 exchange in that context can preserve hundreds of thousands of dollars that would otherwise go to the government. The woman who inherits her mother's rental property in Santa Monica sells it for 1.8 and does a 1031 exchange into a larger property, defers the entire capital gains liability, and builds from a larger asset base. The woman who inherits the same property sells it without a 1031 exchange and pays the taxes, starts her next investment with significantly less money.
The war. The 1031 exchange is not a loophole. It is a deliberate provision of the tax code designed to encourage continued investment in real estate. But it requires planning. It requires a qualified intermediary, and it requires execution with rigid deadlines. The time to understand this tool is before you inherit, before you divorce, before you decide to sell, not after.
The divorce and probate traps. Boy,
Tax traps.
yeah, there's plenty of them, believe me.
There's a lot of them.
Yeah.
And it takes a very
astute person,
accountant or attorney handling all of these and keeping themselves up to date of all of these changes to really help get you through it, especially in divorce and probate. Let's talk specifically about the tax traps in divorce proceedings, because this is where I see the most expensive mistakes made. Alexis.
Oh, yes. The first trap, transferring property between spouses as part of a divorce settlement, is generally not a taxable event. Under Internal Revenue Code Section 1041, the transfer itself doesn't trigger capital gains, but the tax basis transfers with the property. So if you receive the marital home in the settlement, you also receive the original tax basis. If your husband bought that house in 1988 for $280,000, it's worth $2.4 million today. You now hold an asset worth $2.12 million embedded in the gain.
Every dollar of that gain is taxable when you eventually sell.
Absolutely.
The second trap, the primary residence exclusion. A single person can exclude $250,000 of capital gains on primary residence sale. A married couple can exclude $500,000. After a divorce, you are a single person. Your exclusion just dropped by $250,000. If your divorce settlement gives you the house and you plan to sell it, the timing of that sale relative to the divorce filing and finalization can significantly affect your tax liability. This is not a detail. This is a 5 to 6 figure decision.
The third trap, and the one I see destroy the most value, is the retirement account in real estate comparison. In settlement negotiations, people often compare a retirement account to real property as if they are equal assets. They are not. A $500,000 IRA has never been taxed. Every dollar that comes out is ordinary income. A $500,000 equity position in property has a tax basis and a long-term capital gains treatment. These are completely different after-tax value. Comparing them dollar for dollar in settlement negotiation is a mathematical error with permanent consequences.
Absolutely.
Yeah, the step-up basis in probate, that's a tough one.
In probate, there is actually a significant tax advantage that most people don't know about and therefore don't use. It is called the step-up in basis.
When you inherit property, the tax basis of that property steps up to the fair market value at the date of death, not the original purchase price, the current value, which means if your mother bought her home in 1972, which I did, for $85,000, it's worth $1.9 million when she dies. Your basis is $1.9 million. If you sell it for $1.9, you owe zero capital gain tax. That is one of the most powerful wealth transfer advantages in tax code, and it exists specifically for inherited property.
The trap, and there is always a trap, is that the step up only applies if the property actually passes through the estate. If your mother transferred the property to you before her death to avoid probate, you may have received a carryover basis instead of a step up, meaning you inherit her original $85,000 basis along with the $1.815 million embedded capital gain. Avoiding probate is sometimes the right strategy. Sometimes it's not. The tax implications of each path must be evaluated specifically, not assumed. And I think that's something that you need to think about.
Oh, yeah, definitely.
Because, I mean, that step-up basis going through probate might be a better situation for you if this is all going to go down.
Well, I have an irrevocable trust. So it's already given, they're already named trustees. Mm-hmm. So I need to check with my attorney because I am not an attorney or an accountant.
Your actions from this episode: before any real estate transaction, sale, purchase, settlement, distribution, sit down with a CPA or tax attorney. And if you're in California, make sure they specialize in real estate. Not a general accountant, someone who specifically understands Proposition 13, Proposition 19, 1031 exchanges, and the interaction between California and federal tax on real property. The question to ask: what is my tax basis in this property? What are my capital gains implications if I sell? Is a 1031 exchange available and appropriate? What are the property tax reassessment implications of this transfer? What is the most tax efficient structure for this transaction?
California does not reward uninformed. It taxes them. The women who keep the most of what they built are the ones who understand the rules before they make the move, not after the escrow closes, not after the settlement is signed, before the tax conversation is not separate from the real estate conversation. It is the real estate conversation. You've got to include the tax implications.
The question we close with this week: if you sold every piece of California real estate you own or expect to inherit today, do you know what specificity, what you would actually keep after taxes? And does your current plan account for that number? Because in 20 years, the difference between the women who planned and the women who didn't will be measured in millions.
Next week, trust architecture, how to structure your assets so they go exactly where you want them to go, efficiently, privately, and without giving the court system more control over your wealth than it deserves. I'm Alexis Nassif. The inner circle is open.
And I am Natalie Francine. This is Wealth, War, and Real Estate.
For women, by women.
See you next time.
Absolutely. And I think you should explain why you're Dame Francine, Natalie Francine. I think that's very important. You tell the people.
So a very long time ago,
Go ahead.
maybe in I don't remember, 2012, 2013, around there maybe, I was one of the first females in the Knights of Malta that was knighted. I was knighted here in the United States by a very dear friend of mine who is a knight, and I, became a Knight of Malta. And based on what we're doing with real estate and international and, just trying to, it seemed appropriate to put the Dame in front of my name.
Yeah, she's really a knight, a female knight, which is really amazing.
I love that. I don't know that there's a whole lot of female knights, but I'm there.
Yeah, and she even has the whole armor. No, just kidding.
I do have a pin. I do have a Knights of Malta pin, so that's very cool. Anyway, I'm proud of it.
I am, and now I'm going to put my glasses back on.
And we will say goodbye. Thank you for being with us.
Hold on, got to get the glasses on. How do you like these? I think they're pretty far out and solid, as they say.
Yeah, groovy.
See you later.
Bye-bye.
Thank you so much for watching, and please subscribe to us.
Yeah, subscribe. Come on, we have a lot more information. We're going to be doing another celebrity spot that's coming up that we have in development. So look forward.